Are you in the market to buy or sell a home? Maybe thinking about moving? If you're like many knowledgeable real estate consumers, then you're likely concerned about mortgage interest rates. Are they going up? Are they coming down? How will mortgage interest rates impact the sale of your home or the purchase of your next home? These are all very compelling questions. Today's video is an answer to a frequently asked question regarding mortgage interest rates. Specifically, people want to know how the changes in the Federal Reserve funds rate impact mortgage interest rates. With inflation rising, all economic eyes are on the Federal Reserve and what it will do with the federal funds rate. The Fed manipulates this rate in order to speed up or slow down the growth of inflation. The Fed also maintains or changes its stance on buying or selling mortgage-backed securities, which also has a major effect on the movement of mortgage interest rates. The Fed's overall outlook will impact what consumers will pay to borrow money for a home. When the cost of borrowing goes up, home affordability declines. Currently, the Fed has shown signs that the federal funds rate will rise several times before this year is through. So, how will this rise in the federal funds rate impact mortgage interest rates? Just stay tuned. You'll have your data-rich answer in just 3 minutes. If you Google both the Federal Reserve and mortgage interest rates, you'll quickly learn that the Federal Reserve does not set mortgage interest rates. You'll also discover there are many variables that help determine the direction of mortgage interest rate movement. And after a short while of reading, you'll come to the realization you really haven't learned much. There are just so many variables for a layperson to internalize. This is why I like to look at data. I simply plot two sets of data and try to find a correlation. In today's video, I've plotted the federal funds rate and mortgage interest rates over time. The results are telling. This graph plots more than 50 years of the 30-year fixed-rate mortgage in blue and the effective federal funds rate in red. The dashed lines reveal the 10-year average of each, while the yellow highlighted dashed line plots the difference between the two rates. While Google might lead you to believe that the Federal Reserve does not set mortgage interest rates, our data shows a very strong correlation between mortgage interest rates and the federal funds rate. For the past 30 years, we've seen the trend of the difference between the two rates remain very stable, typically with mortgage interest rates marked up 3% to 4% over the federal funds rate. Now, all the websites in Google's database might tell us there's no direct correlation between the two, but I think savvy homebuyers and sellers should take note and expect to see mortgage interest rates rise along with the growth of the federal funds rate. Longtime subscribers to our channel know that I regularly graph every major indicator for the real estate market. If you're not a subscriber, you're missing out on the freshest housing market news based not on shock, rather based upon current data. Please like this video by clicking the thumbs up button and then subscribe so that you get all the content when it is fresh. When you see the federal funds rate rise, expect a near-term rise in mortgage interest rates unless the market already made the move in anticipation of the federal funds rate hike. Let the experts continue to rebuke those that say they are directly related, but I'm going to follow the historical data and have the expectation that mortgage interest rates are pushing higher for the foreseeable future. The Federal Reserve has made it clear and certain that they will be raising the Fed funds rate several times this year, and history tells us that we should expect the mortgage market to follow suit. Not only have they called for small rises, but some members of the Fed have also voiced stronger concerns about inflation. In an opinion published last summer, one Fed committee member said, using the traditional model for determining the proper federal funds rate, today's Fed funds rate should be close to 5%. Not 1/4% that we see today, rather 20 times that at a full 5%. If the Fed acted on that, a federal funds rate of 5% would suggest mortgage interest rates moving above 8% over next year. While I do not expect that to happen anytime soon, we do need to know that the Fed cannot and will not sit on its hands forever. The small token increases in the Fed funds rate this year will become larger ones if inflation does not return near the targeted 2% level. If you're planning a move now or in the near future, and you plan to finance the move, history supports taking immediate action. The supply of homes is too low, so we know that home prices will continue to rise. And now the Fed has signaled its plans that will ultimately result in the rising cost to borrow money. Get yourself into a home at today's prices and today's cost of funds so that you can avoid the largest hit to home affordability that I will have observed in my 30+ years of selling homes. One day, you will look back at this as a time of opportunity, and those that will take action will come out strong. If you would like to see videos about current housing market conditions, I've assembled a great playlist that you can view by clicking on the box on the top left corner of your screen. To see a popular video featuring my top 6 home selling tips, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.